Hey friends, thanks so much for joining us. I have Gary Christenson of the DeviantInvestor.com online. We've been posting all of Gary's work for quite some time, and Gary has written a new book and was kind enough to send me a copy. It's called Gold Value and Gold Prices from 1971 to 2021, an empirical model, and it's a damn good book. Gary, how are you?
Doing good, thank you.
Hey, thanks for sending me the book. I really appreciate that. And I was reading through it last night, in fact, marking out specific chapters I wanted to discuss with you. We live in a society largely based on lies at this point, and I think your book is very helpful, Gary, in helping us reset the expectations for what will eventually happen based on mathematics. They can lie, they can paper it over, they can fix the price of gold, they can fix the price of silver, they can fix the LIBOR rates, they can fix, but at the end of the day, all darkness can be destroyed by one match, by one point of light. And I think your book sort of represents that. So I guess my first question for you is, how did you come up with this empirical model? Why don't we start there before we jump into specifics?
Okay, well, I'm going to reach that topic. I'm going to have to go around about just a tiny bit. I largely agree with you in terms of the manipulation and the distortions in the prices. And that leads you to the next question of, well, if prices are distorted and manipulated, how can you possibly work with prices? Does technical analysis work? Does fundamental analysis work? Does any sort of analysis work if you admit manipulation? And then you have to say, okay, well, what degree do we have manipulation? What degree do we have managed and controlled prices? And then if it's largely controlled, what is left that you can properly and fairly analyze? You see where I'm going on this. It isn't like an all or nothing absolute. There's degrees of manipulation, degrees of control. And so my comment is, well, there must be some way to evaluate what is a fair price for gold or a fair price for silver or a fair price for the S&P or whatever. Well, people use many ratios and many analyses for the S&P, but there is almost nothing out there in terms of gold for a fair price and a fair valuation. So I have a science background, a physics background. I like models. I like an analytical, data-based view of the world. And without denying that there's a lot more to it than that. But if you're going to analyze something, you have to have hard data, and you have to have some reproducible, defensible means of evaluating. So I've been working on a gold model off and on for 10 years, trying to refine it, trying to come up with something that I really thought was plausible and something that was statistically significant. And part of the reason why I failed was exactly what you pointed out in your introduction, that it's hard to create a model when there is so much manipulation, news, lying, and so forth going on. So I decided to bypass all of that. And at the point where I bypassed it, then I got a model that worked. And the way I bypassed it, and I'm sorry this is long-winded, but I'm getting there, is that I took the price of gold and smoothed out all of the short-term stuff, all of the weekly gyrations, the news gyrations, the Federal Reserve gyrations, the manipulation, the distortions that the market puts in it, and just came up with broad trends. And that's what I tried to duplicate in a model, and I believe I have. So does that make sense so far?
Yeah, it makes perfect sense. And, to your point, there are many people who hear about this manipulation story and say, if this is a rigged market, why would you want to put yourself through this hell? You gold bugs are nuts. You silver bugs are nuts. Silver's never going back to 50, much less 200, 300, or 1,000. It will never happen because, as you guys maybe rightly know, maybe not. Maybe you're all nuts or maybe you're right. But it doesn't matter, because if the market is fixed, you will never win. That is the take by many. And so, yeah, your point's a good one.
Well, and I agree that that is the take by many. In fact, I have a number of comments on my website to that effect. And My attitude is, no, you're missing the big picture. You may be seeing the tiny picture, but you're missing the big picture. And the big picture is, yes, of course, the S&P is manipulated. All markets are manipulated to one degree or another. I mean, we've even got indictments and admissions of it.
Gary, let me jump in and back you up on the S&P. We just found out over the past week that the central banks are actively buying S&P futures. The central banks themselves are manipulating the S&P higher, as Zero Hedge has reported.
And I agree with that. And the implication to me, the important point that I see out of that is, my goodness, if they're manipulating the S&P higher and aggressively buying behind the scenes, whether it's in Belgium or whatever, doesn't that suggest serious worry and serious concern on the part of the central banks? Doesn't that suggest imminent danger? I mean, maybe I'm overreacting, but that's the way I would interpret it.
Oh, I don't think you're overreacting at all. I think you're absolutely spot on. And in fact, if we take a look at the historical facts, right, which you note in your book, let's jump to page 33 here in chapter 7, gold prices projected into the future. Let's just rewind time for people. In 1913, the national debt was $3 billion, that's with a B, dollars. In 1971, when Nixon took us off the gold standard, it was $398 billion. 1971 wasn't that long ago. I was alive and on the planet, in fact. Now in 2013, you note that the national debt was at that point nearly 17 trillion with a T, and now we're well beyond even that. And as you note here on page 40, we can assume with 12% annual increases in the national debt over just the next 9 years, the national debt, as officially stated, and we know it's much higher than that, Gary, the national debt in just the next 9 years could be well over $50 trillion. So it takes me back to the beginning, the introduction, when I mentioned mathematics. What you took the time to do with your book is to cover the facts. And the fact of the matter is, this nation is screwed. The dollar is being de-dollarized. The future of the American people is held in the hands of criminals at the Federal Reserve, which are printing us into oblivion. And those are the facts.
And the antidote to that disease, one of them is gold.
Absolutely. And I should ask, for those of us who are listening who are very much silver bugs, as well as people who, I got to stop using the term bugs. It's so dismissive. It's so much bigger than that. We're not bugs. We're not obsessed with precious metals. We're pragmatists. We're realists. We are financially awake. We are among those who want to protect our friends and our family and ourselves from this economic storm which is coming and cannot be stopped. So I guess my question for you is, you've written this book about gold. Do you feel the same way about silver as we move on in the discussion?
Well, interesting that you bring the topic up. Yes and yes. And let me expand on that just a bit. As I have a gold model, which is, in my opinion, fairly comprehensive and fairly descriptive of the gold prices since 1971. And I like to note in there that using an annual prices, I had a statistical correlation of 0.98. And I know correlation isn't causality, but it certainly is cause for interest and attention. One should pay attention to analysis like that is that accurate on a long-term trending scale. So going back to silver, I have a similar model. It's slightly different because silver is a slightly different operation, less of a monetary metal and more of an industrial metal. But I have a similar model for silver, and it projects out to, yes, much larger numbers also. And we all know, based on the history of silver, that silver is much more volatile. So whenever gold finally gets into high gear and starts moving upward, silver will go even faster. And at the same time, when it goes down, silver goes down farther and faster. But yes, silver, I'm very much in favor of silver also. And given that the ratio now is in the mid-60s, silver has a long way to go, because we could easily see a ratio dropping back to, say, 20, which would mean that the movement in silver would be far larger than the movement in gold. And I see the movement in gold as being substantial in the next 5 to 10 years. And I'm saying that, as you noted in the book, based on just the mathematics of the situation and just the political realities. The political realities being, nobody expects the debt to get under control. Nobody expects the debt to be managed. And geopolitically, why would we expect anything but exponentially increasing money printing and exponentially increasing money supply? And those are the drivers, those are important drivers in the price of commodities, specifically gold and silver. So yes, we should expect both prices of gold and silver to go much, much higher.
Okay, and I want to follow up on a couple of things you just said there and then circle back, because sometimes in these interviews I get ahead of myself, and then when I listen to them before posting, I realize that I steamrolled over a point. So I want to go back and talk about the gold prices being managed and manipulated, as you note in Chapter 8. But you mentioned the gold to silver ratio, and I just want to flush that out for anyone new who's listening. The historical ratios of silver to gold, going all the way back to Roman times, were 15 to 1. 15 ounces of silver, 14 or 15 ounces of silver equaled 1 ounce of gold. Now, Gary, as you know, the mining ratios in modern times, really just over the last 5-10 years, the ratio of silver being mined out of planet Earth has fallen to about 9 ounces of silver for every 1 ounce of gold they find. So when we take a look at the manipulation, when we talk about the silver fix, which we can do, when we talk about the managed prices, when we talk about the de-dollarization, and we know that the geopolitical realities are that China and Russia are hoarding as much gold as they can get their hands on. My point, Gary, is that the silver to gold ratio at 65 or whatever it is to 1, when they're only pulling 9 ounces of silver out of the ground for every 1 ounce of gold, the only conclusion we can come to is that they are fixing these prices. But we know they're fixing the prices. That was a long way to go to get to this question, Gary. What do you make of this new silver fix?
You know, I've read a little bit about it. I don't have a firm opinion, but my general idea is ho-hum, why bother? It's not going to change anything. What will finally change things, and Ted Butler's talked about this extensively and intelligently for 2 decades, is simply buy the silver physically, take it and keep it off the market. And the more that we have silver as a physical market, the less it becomes a paper market, and the more then we get a real price for silver and the real price for gold. And this, we see signs of this happening with the Shanghai silver market,
Right.
which is a cash basis metal market, not a paper market. And the same thing with gold. It gradually, I believe, and I say this based on what I read and my general expectation, is that the paper market is largely a fiction and the physical market is real, and gradually the fiction will dissolve and the reality will become more important. So I believe the center of the gold and silver market world will over time move toward Asia, or at least stay only in the Western world if they go to more of a physical market and get off of the fraudulent paper market.
Yeah, you're absolutely right. And as our friend SRS Rocco has noted, the physical silver supplies on the Shanghai exchange are absolutely plummeting. So your point again is a good one. Now I want to circle back here to gold prices are managed and manipulated, because as we've just noted, the same is true for silver. And on page 37 of your book, you write, the important questions are, since it is clear gold prices are manipulated, how can I trust gold price? And why buy in a rigged market? This is the part where we circle back, because I think I steamrolled over your answer before, but let's just flush this out again for those who are leaving nasty comments down below about how we're nuts and we're crazy and we can never win because the prices will always be fixed.
I'm back to the same old story. Yes, the prices are fixed, but that doesn't mean that you can't win if you look at the bigger picture. And the bigger picture, and that's why I tried to look at 43 years of gold prices and said, well, the defining event in the recent history of gold was Nixon going off the gold standard, which was critically important for multiple reasons. It allowed the T-bond market to go from a boring little market to an incredibly important worldwide market, and it allowed the exponential increase of money supply, and because nothing was tied to a quantity of gold anymore. And so to me, that was the critical point in the change. So then we go forward from that, and when you look at what's going forward, skip all of the short-term stuff, and by short-term stuff I mean monthly and even quarterly gyrations. the trends are very clear. Gold went up into roughly the early 80s, went down into roughly 2000, 2001, and has gone up since then. And that's the big trend. The little trend in between is where you have people selling off massive amounts of gold futures, like, say, in April of 2013 and June of 2013. But in the overall scheme of things, that is utterly important to the short-term trader and utterly unimportant to the long-term investor. And that's what we have to look at, is the long-term investor is the one who's going to lose. Is the one who's going to win, and the short-term investor who gets whipsawed by paper products is the one who's going to lose. So the way you win on this is, don't focus on manipulation, focus on the reality, focus on the fact, focus on that 1 ounce St. Gaudens gold coin that you're holding in your right hand, and focus on that as reality, and the paper as gradually just fading off into the sunset, not being real. And that's easy to say and hard to do, but that is the way to win.
Well, it is the way to win, and it's very much the contrarian investor that's buying physical precious metals, because everybody else is piling into the stock market. Everybody else, even those who didn't want to reparticipate in the stock market, even now there's a lot of people that are talking about it, even where I work, and people are getting excited about the stock market because it seems to only be able to go higher. But the reality is we know that that is a manipulated market, and manipulations can't go on forever. That's, I think, the bottom line here, is that they can't manipulate it higher forever. Eventually, things return to the norm. And I think that one of the most important things you write in your book here is on page 59 in your chapter about counterparty risk. I was talking about this at work just yesterday with some friends, and we were talking about the fact I brought up that Wall Street bankers continue to warn that hackers could bring down the American banking system at any time. And of course, they're trying to say that it would be from hackers out of Russia. I guess right now, if they had their sights set on Iran, they would be telling us the hacking was coming from Iran. But here's the point. The FDIC can't insure all the deposits in all the banks. They can only insure a fraction of 1% of all the deposits. Even worse, the ones and zeros in your brokerage accounts from Wall Street. And you write on page 59, it's critical to note that gold and silver bullion have no counterparty risk. They are assets without any obligation to or from any other assets, debt, government, or financial institution. Repeat, physical gold and silver have no counterparty risk, unlike almost all other non-tangible assets. In the event of a monetary or economic collapse, possession of physical gold and silver will be important to your financial survival and perhaps your life. I think that sums it all up in a nutshell, because those who are listening to this interview understand the realities that we're facing. The sheeple people don't, but those listening do, and I think that that's a very important passage out of your book. There's no counterparty risk to owning physical silver or gold. It's real wealth in your hand. It's tangible, and nobody can take it away from you.
That's what I was talking about. Hold that 1 ounce St. Gaudens gold coin in your hand and see if it doesn't give you a good feeling. And then by contrast, and I don't mean to pick on the S&P horribly here, but by contrast, look at the S&P 500, roughly 2,000. It's up roughly triple from where it was 5 years ago. And not to take anything away from that, but is it real, and how much of that it has been simply pumped up by central bank purchases and central bank zero interest rate arrangements, and the fact that people feel they have no other place to go. And that doesn't make the 2000 unreal, but it also makes the 2000 rather bubbly. And what happens when some of the air goes out of that bubble and it pops and comes back down, which it inevitably will at some point. And I point out a couple of things on that. If you look at margin debt on the S&P, it's huge, and it's strangely coincident. If you graph it, looks very much like 2000 and 2007, and we all know what happened in 2000 and 2007. And the second thing is, you look at sentiment, and if you take the bulls minus the bears and look at sentiment, you see that sentiment is similar to 2000 and 2007. It's very, very high, very, very bullish. Well, sentiment is a fickle thing, and it can reverse on a dime. But more importantly, sentiment is always an indicator of when something has gone too far too fast. And when a market has gone too far too fast, it will reverse. There's a third thing that I'd like to point out, and then I'll get off the S&P topic. But if you look at the S&P long term, let's take a picture of the S&P for 30 years, and I have an article coming out on this in the next couple days. Take a look at the S&P, and you'll see a peak in 1987, and 7 years later you'll see a peak in 1994, and 7 years later you'll see a peak in 2000, 2001, plus or minus a couple months here. 7 years later you'll see a peak in 2007, and 7 years later is 2014, and we have a peak. And I'm not saying that cycles are guaranteed, but it's rather coincident that we have 5 7-year periods, and at the end of each 7-year period we have a major high in the S&P. And then if you look at some various indicators, some oscillators, technical analysis, and so forth, they show seriously overbought conditions right now. And to me, that should be alarm bells and time for caution. And then the corollary to that, bringing back to gold, is the S&P and the bond market and the treasury markets are huge markets. A couple $1 billion pulled out of those would be a rounding error, and yet a couple $1 billion would buy up essentially all of the silver mined in a given year. And so what would that do to the silver markets? And 100 times that would buy up the gold for the year. So really, it wouldn't take very much money moving out of the treasury markets or the S&P into the precious metals to drastically move those markets higher. And what would cause that? Lack of confidence, worries, potential war, recognition that confidence in the dollar is weakening, Saudis choosing to buy oil in something other than the dollar, and lots of dollars floating back to the United States. Any number of things like that could cause a crisis of confidence. And at the central point of all money that is fiat backed, that is nothing backed by nothing but faith and trust, is confidence. Confidence is a critical factor. We weaken confidence, we weaken the value of the money, we weaken the value of the dollar, and we weaken the markets that are supported by the dollar, which are the treasury markets and the S&P. And that feeds back who knows when, although now is a pretty decent time. When I say now, I mean plus or minus many months. That feeds back into where will people go when they want no counterparty risk, and that, of course, is gold and silver.
Yeah, as you were talking about the S&P and those 7-year cycles, I called up a chart that we posted just the other day from Zero Hedge, and the name of the post was "Obviously Not a Bubble." That's the very definition of sarcasm, because you can see the peaks, the bubble peaks that you were talking about in 2000, 2001, then again in 2007, 2008. In the current bubble that we are now in is far higher than either of those two peaks. And that is really the empirical data. That is the proof of the central banks buying and supporting and manipulating these markets higher. And when it ends, I don't know. I don't think anyone does. But when it ends, it's going to end very badly. And we're not suggesting that any profits that have been made in the markets aren't real profits. People can get out of stocks. They can take that money, turn it into real cash, and then exchange that cash for real physical precious metals. Hey, if you've been in the stock market since the 2008 bailouts, that market low, I think, Gary, was what, around 6,000? The Dow low, I think, was around 6,666, if memory serves.
The S&P was 666, yes.
Oh, was it the S&P? I think the Dow did a similar thing.
Yes.
I do remember that on one particular day. I think that was a real sign of a bottom. But the point is that if people have ridden this thing higher, they've really ridden the coattails of the Fed to unimaginable heights. And I don't know, the Rothschilds always said, Gary, give the last 10% to somebody else. We get out, but we give the last 10% of a market rise to somebody else, because they are masters at protecting their capital. Of course, they're masters at manipulating the markets to the point of being able to buy up the central banks. But the point is why would people stay in the market at this point after this run? This run has been absolutely unprecedented. And maybe we should close out by talking about Chapter 9 and talk about the price of gold. I know Sinclair has talked about $12,000, $14,000 gold. You've picked a number here, and it's $10,000 an ounce gold. And in Chapter 9, you ask, is $10,000 gold possible, and what would be necessary? Do you want to talk a little bit about that?
Well, sure. And again, back to my model, it's an empirical model, and the model is based on three primary variables, one of which is the U.S. national debt, because it's an easily measured and very reliable variable to work with. So all I did was I said, well, Sinclair's talked about $10,000, and it's a nice round number. It's an easy number to remember. It's a scary number because if gold goes to $10,000, there'll be a lot of other changes in the world, some of which won't be pleasant. But we have to face the facts. Let's be brutally honest about the facts. So I picked $10,000 and I said, what would be necessary? Is this completely out of line? Is it completely unthinkable in the context of this model? So trying to be intellectually consistent and honest about the model, let's feed some numbers into the model and say, what would it take to get a $10,000 number at the other end of the model? And the answer is it's possible. It's not possible using the model in the next year or two, but if you project numbers forward in terms of the national debt and the other variables that I use, and you say, let's just assume more of the same, and by more of the same I mean we're going to be cranking the money supply, we're going to be spending money we don't have, we're going to be increasing the debt, we're going to be inflating prices of things, then it's quite reasonable to get to a spike price of $10,000. Now, that's not even assuming a financial crash, that's not assuming hyperinflation, that's not assuming an economic crash, that's not assuming a loss of confidence in the dollar to the point where it plummets to, say, a third of what it is right now on the international markets. I'm not assuming any of those things. I'm assuming just more of the same, and more of the same kind of conditions that we've had for the last 43 years, and then it's plausible to see a $10,000 spike in the price of gold in the vicinity of 2020, 2021. That's my argument. Without any extraordinary events, such as a Zimbabwe-style inflation or a Weimar inflation, we can get there with just continuing what we're doing, because what we're doing is dangerous in economic terms.
Yeah, it's very dangerous, and I just want to back you up here. Swiss America put out this article a while back. 133 analysts believe gold will go parabolic, and you're certainly not alone. Let's just cite some of these names. Porter Stansberry thinks gold will hit $10,000. You've got Robert McEwen says $5,000. Mike Maloney is saying $15,000. Jim Sinclair, as we noted here, has said $12,455. Martin Armstrong, who, like him or hate him, the man knows his stuff, he says $5,000 to $12,000. Jim Rickards, $4,000 to $11,000. So 11 analysts alone see gold going parabolic to $10,000 or more. And I don't think your $10,000 number is out of line at all. And I guess maybe it's fair to ask, where do you see silver going? At some point, this silver fix is going to break. At some point, the physical story is going to win out. And at some point, physical silver is going to reach a real-world price. If we could make the argument for $10,000 gold, would you care to make an argument for the price of silver?
Well, and that gets extremely speculative with silver, but yes, I'd be happy to make an argument for silver. The $10,000 number for gold has been backed up by a number of other very reputable people who happen to think just a little bit outside of the box. And by thinking outside the box, I mean if CNBC and the State Department published it, then I'm not too interested. But if somebody is looking at something beyond the status quo, you could see $10,000 gold. Then going back to the gold-silver ratio, if we assume that the gold-silver ratio drops to some much smaller number than it is now, say dropping from 65 to say 10 to 20, then that puts the price of gold or the price of silver somewhere in the $500 to $1,000 range. And that's, from my mind, pretty hard to conceive of. But I think what you have to say is, in an environment where gold has gone to $10,000, what will the price of crude oil be? What will the price of bread be? What will the price of gasoline be? And in that context, maybe $300 to $500 silver isn't out of line because the dollar just doesn't buy much at all anymore. So I think that that's a good way to look at the price of silver in terms of ratios. In other words, I think seeing $100 silver in the next 3 years isn't at all surprising, and seeing $500 silver on a spike that may not hold is quite possible if you see gold hitting $10,000. Does that more or less answer your question?
Well, absolutely it does. And for the naysayers, I just want to point out the fact, because people, Gary, as you know, will constantly say, $1,000 silver, that's not a world you even want to live in, because if silver's at $1,000, then the world's been destroyed and America is over, and there'll be riots everywhere. And I don't actually agree with that, because if people can just take a look at the palladium price, right? I think in 2009, Gary, it was just under $200. Now it's just reached, I think, a 5-year high. I think it's just reached 900 and change. And I'll tell you what, the world is oblivious to the price of palladium. Just as the world is oblivious to the price of silver. Ask your neighbors if they know how much silver trades for. Ask your neighbors if they own any physical silver. Ask your neighbors if they own any physical palladium. They don't care. They don't know. So if silver went to $1,000, it does not necessarily spell the end of the world. It probably spells the end of the dollar. But I do like to use that palladium story as an allegory, as a metaphor for what could happen to silver. Palladium's gone from 200 to almost 1,000, and nobody cares. The markets don't care. Corporations don't care. They continue to make their catalytic converters for the cars. They continue to use palladium no matter what the price is, and it makes no difference to the way life works in this country. So my point, Gary, is that silver could make a run and find its equilibrium, find its real-world price based on demand in China, based on demand in Russia, based on demand, real-world demand here in the United States. It could finally find a real-world price that is in the hundreds of dollars, and it probably won't impact the world very darn much.
Well, and I agree. And if I may interject here just one more point, on page 85 of my book, I'm making a comment about, is 7,000 to 10,000 gold outrageous? And my comment is, well, yes, at first glance, these prices do seem outrageous. But consider for perspective. Apple stock rose from about $4 in 1997 to over $700 in 2012. Now, that's pretty outrageous. Okay, silver rose from $1.50 to $50 in less than 10 years. Outrageous again. 30's a factor of 30 on that. Gold rose from $40 to $850 in less than 10 years. Crude oil rose from less than $11 in 1998 to over $150 in 2008. So in 10 years, it went up way more than a factor of 10. Outrageous prices are only because we haven't factored in all of the factors that will change in the future, and that will drive our current world into a very distorted version in the future. It's possible to see Apple stock go from $4 to $700, and it's possible to see silver go from an outrageously low price now of roughly 20 to easily $100 or $200. That's quite possible. I mean, think of what a $1.50 to $500 to $50 change in silver was in 10 years. That's like a ratio of 35. $20 times 35 is 700. That's the 2010 to 2020 equivalent move. So $700 silver right there using that same ratio. I'm not forecasting that, but I'm just saying don't rule it out.
Yeah, I think in a world gone mad, and I literally mean in a world gone mad, with NATO surrounding Russia and the war drums constantly beating, and the remarketing and rebranding of Al-Qaeda as ISIS, IRS can get away with all measure of crimes and nobody goes to jail. The markets can be manipulated, the silver fix, the gold fix, the plunge protection team, the Federal Reserve buying up S&P futures. In a market gone mad, in a world gone mad, anything is possible. And the bottom line for those of us, again, we're not silver and gold bugs. We're people who are pragmatists. We're people who are liberty lovers. And we're people who are trying to divest from this criminal paper Ponzi death-based system. And Gary, I really do appreciate your book because it helps, really realign our minds again with facts, because we're swimming in a sea of propaganda daily. And of course, my website, as you know, is the Corporate Propaganda Antidote. We try very hard to get out real news and real information every single day, and posting your articles is one of the ways we do that. Gary, could you please tell people how they can support your great work and purchase this really fun-to-read, well-written book?
Well, there's several ways. The first and obvious way that most people will probably choose is Amazon. It's available as an ebook on Amazon, $7.95. It's available as a paperback on Amazon, and the list price on it's $12.99. I think Amazon discounts at about $1.30. You can also buy it directly from me at my website, and that's gechristenson.com. That's the way to buy the book. The book is a valuable book. It's focused and it's narrow to the topics at hand. It's very specific and gives valuable information that people can use. Why do we need a model? What the model does? What are the risks? We'll talk about manipulation. Talks about when and how to buy gold and silver. Talks about the bubbles that have occurred throughout history and how to recognize a bubble. Just as an example, when your barber and your hairdresser are talking to you about the silver they bought, it might be time to get out. That's the type of thing that's in the book. It's practical, simple, basic stuff that'll tell you when, how, and why, and where. And don't be married to the investment. Get in, write it, and don't believe the story that the regular media is telling you, and then get out and then move on to the next thing.
Well, Gary, we really do appreciate your time, and thank you for taking the time to go over your book with me, and thanks so much for sending me a copy of the book, which I would note you also autographed at my request. I really appreciate that. That's cool. And guys, a lot of times people will say, how can we support SGT Report? Why don't you guys have a donate button? Hey, we're really proud to be able to operate the site with the support of our advertisers, so we don't take donations. We never have. However, if you do want to support us and support the community, please click through, go to Deviant Investor, go to Amazon and buy Gary's book, Gold Value and Gold Prices. You can get it for about $10 in an actual physical copy like he sent me. And I think that would be a really cool thing to do, and it's a cool way to share real information, easy to digest, real quantifiable, hardcore information with friends and family, those who you may want to wake up. So please do that, and as always, thank you so much for your support. Visit us at sgtreport.com for real news 24/7, and check out our other website too, the sister site, thelibertymill.com, also spreading real news and information from the trees that bear fruit. Gary, thanks so much for joining us.
Thank you.
All right, talk to you soon. Thanks, guys, and have a great week. Bye-bye.